Hello! Today we're going to be talking about how to record straight-line depreciation expense when a company revises their depreciation estimate. What I mean by this is that sometimes after a few years of using an asset, such as a machine or a building, a company might begin to rethink some of their assumptions that they had about the asset, such as how many years the asset will last for and how much the asset will be worth at the end of its life. Revisions in these assumptions require new calculations to account for the change in depreciation expense, which will be the focus of this video. So the question says, Green Acres Farm purchased a tractor for $50,000 on January 1st, 2009. The tractor is assumed to have a 10-year useful life with a $10,000 salvage value. Record the adjusting journal entry on December 31st, 2009 to record the depreciation on the tractor. So notice right here that this tractor was purchased on January 1st, 2009, and now we are on December 31st, 2009. So that's 1 year later, after 1 year of the tractor's life. And you might remember that the journal entry for depreciation expense is always the same two accounts. It's going to be a debit to depreciation expense and a credit to accumulated depreciation. Now the question is, what amounts do we need here for the debit and the credit? Well, that's going to be dependent on this formula over here, which is straight line depreciation per year, which equals the cost minus the salvage value divided by the useful life. So we can calculate that here in this cell. We can take the cost, we purchased it for $50,000, subtract the salvage value, which they told us was $10,000, what we think we can sell it for at the end of its life, and divide that by the useful life, which is 10 years. So that tells us that we depreciate this asset at $4,000 per year, and that's going to be both our debit and our credit. So if we look at the next part, it says assume that on December 31st, 2011, the tractor's estimated useful life was revised from 10 years to 8 years. Also assume that the estimated salvage value was changed from $10,000 to $15,000. Prepare the adjusting journal entry on December 31st, 2011 to record depreciation of the tractor using the revised estimates. Once again, the company uses the straight line method of depreciation. Okay, so since we have a revised estimate, we need a revised formula for depreciation. So here is the revised straight line depreciation per year formula, which is going to be book value minus new salvage value divided by the remaining years. And just to break that apart a little bit, I've put this into 3 different steps here. So we have step 1, which is to find the book value, which is the cost minus the accumulated depreciation of the asset as of the date of the revised estimate. So in this box, we can do that calculation. That's going to be equal to the cost, which hasn't changed at all. It's still $50,000. And then we subtract that by the accumulated depreciation. Now we have to think about that for a second. This is the accumulated depreciation, meaning the total amount of depreciation recorded on the asset up to this date. And we already know that it was $4,000 per year. And as of December 31st, 2011, which is when we're going to be doing this new journal entry, there have been 2 years worth of depreciation recorded. There would have been 2009 and then 2010, and we're about to do 2011. So that's 2 years of depreciation already recorded, times $4,000, 2 times $4,000 is going to be $8,000 of total accumulated depreciation. So we subtract $8,000 here to give us a book value as of the date of the revised estimate of $42,000. Alright, so step 2 says determine the number of years of depreciation expense that still need to be recorded on the asset. So if we read closely here, they say that the tractor's estimated useful life was revised from 10 years to 8 years. And we already said just a moment ago that we've already recorded 2 years worth of depreciation expense, right? For 2009 and 2010 already would have been recorded. So since there's 8 years in total now, minus the 2 years that have already been recorded, that means the remaining years are, well, 8 minus 2 is 6 years. Finally, we can calculate the depreciation per year under the revised estimate using this formula. So we take the book value, which we already found to be $42,000. We subtract the new salvage value, which if we read closely here, they changed it from $10,000 to $15,000. So we type $15,000. and then we divide that by the remaining years, which was 6 years. And that gives us a revised depreciation per year of $4,500. So we're basically done. All we have to do is put this into a journal entry. So again, that's going to be depreciation expense for $4,500 and accumulated depreciation also for $4,500.